Yeah, hi there. This is Bernhard Koepp at CJ Lawrence. It is July 21st, and I wanted to give you a midsummer update on what we're seeing in the markets. Well, look, our second quarter letter has gone out to clients. It's been quite a year. As the second quarter was another positive quarter. There is a saying in Wall Street, sell in May and go away. Well, if you did that this year, you would have missed out on about 10% return. Let's look at the indices. The S&P 500 hit 20% plus just the other day. Many of the other indices, like the tech-heavy NASDAQ, are up twice as much. Even if you look at the international markets in Europe, many of them are up double digits as well. So it's been quite a year already. So what is driving this? Better macro is obviously one of the parts of this. I'll talk a little bit about that later. But more importantly, it's a new product cycle. And look, we've already been publishing on this before. Our strategist, Terry Gardner, has been talking about it. And it's really the phenomena of generative AI. All of you, or many of you, have heard about ChatGPT by now. This is something that was launched back in November of last year by a company called OpenAI. Generative AI, in simple terms, is a system capable of generating text, images, or other media in response to prompts. So it's a new form of artificial intelligence which really responds to human beings. So you can basically talk to it, and it will respond to you and give you responses. This is very different, or it's a next phase of AI from basically running algorithms or learning from using algorithms or mathematical formulas to solve problems. This is now an interactive software that allows the user through prompts to get responses. And this is very powerful if you think about it, because the system scrapes data from the internet. So basically anything that's floating around in the web is fair game. And today there was a meeting at the White House where the president summoned some of the leaders in this space to discuss, okay, where is the boundary for this scraping of data in the internet? So there will be lots of regulation, I'm sure, and guidelines coming out to this, but this is a very exciting and scary development at the same time. So why are we excited about it? Because, look, there was a Goldman Sachs report that just came out that basically says within the next decade, corporate earnings should be driven 30% higher in most cases, or in some cases, through this new software or this new application. So we're seeing this play out already amongst the large tech companies. And you've heard of the company Alphabet. So they invented Google, or Googlings, the search. So the whole search business, or search, the way search was done in the past, will be completely transformed through this generative AI. You won't be putting in a sentence, where can I find this or that? It will be an interactive dialogue, if you will, between the search engine, which will have generative AI functionality. It will give you complete sentences back and curate the responses for you in a almost human-like kind of response. So this is where there is this battle galore happening right now between Microsoft and Google. Google is obviously the market share leader in search, but Microsoft also has a search engine where they're incorporating these generative AI functionality into it. So it's going to be very interesting who will dominate the search space in the end. We've seen companies like Meta platforms. So Meta is the old Facebook. They launched a new version of Twitter. All the issues surrounding Twitter have opened the door to a second competitor. It is amazing within days, this new Twitter, which is called Threads, garnered 100 million users within a couple of days. I mean, this is an incredible effect. I mean, Meta already controlled 2 billion users, so you could argue that that's not surprising. But if for a new application to attract this many subscribers and users in that short period of time is quite remarkable. And what Meta is doing, they're using these new generative AI technologies to create a better user experience. And if you think of the generative AI software experiences that we will see in the future, they're all centered around better user experiences. Think of things like call centers. I mean, how many of you have been on the phone for hours and hours, and then you get some call center in the middle of nowhere telling you things that you already knew or not being able to help you? Generative AI will probably replace very simple functionality within large companies that are service-oriented, whether it's in the travel industry or in the healthcare services industry, basically answering questions in a more succinct way and probably even more informed way, because it can scrape data much more efficiently than a human being can. So that's going to be very transformative for many sectors that we're following. We're seeing it also in images, so pictures. There's a company called Adobe that we've had in the portfolio for many years. They just launched Firefly. It's an amazing new generative AI-driven software where you can prompt it to say, okay, I want an image to depict this or that. So you no longer need to be a professional web designer to navigate through complicated software. You can really ask it, I want to show an elephant swimming through a lake. And it will generate that image for you. And if you want to pair that with text, you can also ask it to do that without being a professional web designer or a curator of photographs or whatever. So it's really the experience that's being transformed here through generative AI. There's another company that we just added to the portfolio called Oracle. So, Oracle has been in the database business for decades. I mean, they are the gold standard when it comes to databases. So they acquired a company in the healthcare space last year called Cerner. So think of all the functionality that's incredibly inefficient within the healthcare services space and the user interface when it comes to patients that will be transformed through generative AI. So we're very excited about this new technology. There will certainly be very scary headlines relating to generative AI as well, which we're watching with interest. So it'll be interesting to see how regulators catch up with this technology as it's being rolled out. So look, beyond healthcare, beyond technology, there's also healthcare that we find very interesting on the medical device side. We had this period during the pandemic where elective surgery was very difficult just because beds weren't open at the time, and anything that was elective, whether you needed a new knee or a new hip or a stent or pacemakers, things that are less urgent in some cases, these things were put off. So we're seeing a new growth wave in the medical device side. So we're very excited about this space in the healthcare space. Those include names like Medtronic, Zimmer Biomet, and Stryker. These are the bulldogs, as we call them, in that space. And we're also still very excited about what's going on with the big pharma companies like Eli Lilly in the innovation and these new treatments for everything from Alzheimer's and obesity. I mean, these are very exciting developments that are happening in these companies, and we're seeing that play out in the stock prices of companies like Eli Lilly. So turning to macro, look, we were cautiously positioned going into 2023. the inflation dragon hadn't been slain yet, and many reputable economists were forecasting an imminent recession. Europe seemed to be heading for a severe energy crisis. China had not sort of reemerged from its zero COVID policies and lockdown, and and our Fed, Jay Powell, was going to put us into a severe recession with his interest rate policies. So, well, guess what? None of that happened. So the good news today is inflation is now at the latest reading for inflation for June is 3%. That is a remarkable, if you think about where we were just last year at 9.1%. So we're at 3%. The Fed's target for interest for inflation is 2%. We're at 3%, so I would not be surprised if we didn't have a two handle on inflation sometime soon. That has basically put the pressure off when it comes to yields. Look, we saw yields peak in March, and that was because of the banking crisis. We saw three banks back in March basically go under, starting with Silicon Valley Bank and followed by Signature Bank and First Republic. I mean, these were not unremarkable events, and we've seen banking crises before. I am old enough to remember the savings and loans crisis. That was in the late 80s and early 90s, where 1,000 savings and loan banks, or thrifts as they were called at the time, went under. The next banking crisis we went through was in the Great Recession. That was the 2008 and 9 period. We first lost about 25 banks in that initial period, and then another 400 after that. So two things to remember from those events was each one of those banking crises actually set up a very nice equity market, equity bull market following those banking crises. So look, are three banks that we saw going bust this cycle it? Probably not. And interest rates are still quite high, and there's still a lot of pain when it comes to the pressures from severely restrictive interest rate policies. We're still seeing that, and I would not be surprised if something breaks in the second half of the year. But it was also interesting to see in March, when these banks went bankrupt or were taken over by the larger banks. JP Morgan, for instance, took over First Republic. It was interesting to see yields peaked. So basically the read-through was, okay, we have an event, and the Fed is going to factor in the effects of this banking crisis, which is basically a pullback or or banks becoming less willing to lend money, which is something which dampens the economy and is deflationary. So we saw a peak in yields in the 2-year and the 10-year already in March, and the stock market sold off at first and then rallied off that bottom. So we saw an interim bottom again in that period. Yields went back up again in the sort of the May period, and then we got the data, the inflation data for June at 3%, and the market said, okay, I think the inflation dragon has been slain. We don't need to worry too much about inflation anymore going forward, given the data that we've seen. So look, we still have an inverted yield curve. Inverted yield curves are usually a predictor of recessions. We are also predicting a recession, but I think it's fair to say at this point, the recession that we're expecting is going to be quite shallow. And the reason is we have very strong employment, and if we are near full employment, I mean that's going to slow for sure, and wages are still quite elevated, although the growth rates are coming down now. We're going to see quite a slowdown. So we don't expect to see a recession, and this is really leaning on our favorite economists. We don't think we will see a recession until the fourth quarter of this year. So we would expect negative GDP growth in the fourth quarter of this year and the first quarter of next year. The market is kind of looking through this because the market is trying to gauge the level of earnings per share. There are some kind of doomsday estimates for S&P earnings at like 180. Well, we are at 210 or 215 still in terms of the estimate. So we're a long way from the most pessimistic views on earnings. And we're seeing, we get more data every day on earnings, but it's really the key is what is next year going to look like. And look, if we can hold earnings at this level and then make it through the shallow recession, then we are going to see a relief in earnings in 2024. So what is that kind of set up for next year? Again, leaning on our favorite economists out there, we are looking at a scenario where we could be at a low growth environment for GDP between 2 and 3% in 2024, combined with an inflation rate about the same. So that means nominal growth. That is the taking the GDP growth minus the inflation rate, nominal or plus the inflation rate. The nominal rate then is quite low. So what does that mean for stock picking? It means that you got to be tilted back to more growth type companies that have secular growth drivers, because we're going to be back to an environment that's quite slow growth. So in a slow growth environment, companies that have sustainable longer term growth will get premium valuations. I mean, that's the kind of thing we are focused on going into next year. One thing to end the macro or round out the macro piece is our view on the dollar. I mean, typically when interest rates peak, you also get a peak in the currency. So we're already seeing that in the US dollar, which has weakened, and that is actually good for our companies who have revenues abroad. So there will be a good tailwind for S&P earnings going forward because the weaker dollar, and that's because almost half of the revenues of the S&P 500 are coming from abroad, and many of our companies in our portfolios are even more so skewed to international earnings. So to sum it all up, we are still seeing plenty of interesting opportunities to invest in. Many are saying this is an expensive market. I mean, for investors like us who tend to be more growth investors, it's not. If we look at next year's multiple, it's about 18.5 times. We've seen a lot higher in the past, so we continue to add interesting stock positions to our portfolio. And also on the fixed income side, it's quite interesting. We are getting to the point where we can start thinking about extending maturities or duration on the fixed income side. So that's a lot at the mid-year. So we feel like we are well positioned in the portfolio and continue to be optimistic about the second half of the year. Thank you very much for listening.